I'm back. This is Lacey Robertson, the hardest working woman in mortgage and real estate conducting business nationwide. I'm here in my office again, and I want to title this video, Know the Difference. Okay. So many times I get phone calls, I get emails, and homeowners are throwing terms at me or their conversations with the bank, and this is what they signed up for. And once I explain the difference between the two, they are at awe because they're like, that's not what I wanted, but that's really what they signed up for. And unfortunately, if they ask any questions to their bank, the representative that they have on the phone can't answer their questions because all they do is read notes. That's a whole nother video, people. Please believe me, whole nother video. We'll talk about that next time. But anyways, I'm titling this video, Know the Difference, and we're going to go over 4 terms that are alternatives to foreclosure that involve keeping your house, but they're totally different. Okay, let's start with the first one, forbearance. A forbearance, I like to say, is a short-term option. Okay, it's not permanent at all. At all. So forbearance means that a bank will lower your payment considerably. Sometimes it's zero, believe it or not, for anywhere from 3 months, 6 months, a year, usually never exceeds a year. But after that, you have to qualify for a permanent option. So you still need to qualify for a loan modification, a repayment plan, or short sale after the forbearance. So let me give you an example. Let's just say there's one person on the loan, you actually lose your job, you're collecting unemployment, you would most likely qualify what is called a unemployment forbearance. So for the time that you're on unemployment, not to exceed a year, you can have a reduced payment based on unemployment income to allow you to look for a job. You don't have to worry about going into foreclosure. So one example of that, go to facebook.com/simple loan modification. Look at my albums. Find an album called City Mortgage, Dollar Mortgage Payment. That particular client, I negotiated with the bank to allow them to have a dollar mortgage payment for an entire year to allow them to look for a job. Once they landed employment, we did a permanent loan modification and everything was great. Okay, so that's an example. Another term that is misunderstood is a repayment plan. Repayment plan, I like to say, is a semi-permanent option, if you will. Okay, so this is an option that, let's just say, ordinarily you can afford your mortgage, but you ran into an unexpected expense. It could be medical, it could be car, you need an alternator, a radiator, one of those aiders. Anyways, so ordinarily you can make your payment, you had an unexpected expense, so you had to miss a month mortgage payment, or maybe even 2 months. What'll happen is when you can make that next month, the 3rd month, if your contractual mortgage payment, your normal mortgage payment is like $800, what the bank will do is the 2 months that you miss or the month that you miss, they will allow you maybe 3 months, 6 months, depending on how much it is, a year, to pay a little bit extra each month to catch you up. So the reason why I say this is semi-permanent is because if you complete the repayment plan, you're good to go. It's a permanent option. You go back to your contractual payment, everything is gravy. But if you don't, you risk going into foreclosure, okay, depending on how far behind you are. So again, a forbearance, short-term solution, repayment plan, semi-permanent solution, and then we have a short-term refinance versus a loan modification. Short-term refinance costs. Banks charge you to refinance any loan. A loan modification, virtually free if you contact your bank. It's free. Directly, you contact them. One's free, one costs. Short-term refinance, they will usually forbear or forgive a certain portion of the balance to help you get a affordable payment. Thank you. So if they forgive, obviously you don't owe that amount. If they forbear, that just means a portion of the balance. They're not going to charge you interest, or you don't have to make any payments on that. Okay, so that's what a short-term refinance will do for you. Loan modification. I love loan modification. It is a permanent solution. It is awesome. I like to say this is the by any means necessary. We're trying to make your payment affordable. So many things that can be done, from lowering your interest rate to extending your loan, to principal forgiveness, to principal forbearance. So a combination of all of those, or some of those, to make your payment affordable. So this video again was titled Know the Difference. I hate when homeowners sign up for things that they don't know what they're signing up for, so I'm just trying to educate here. And again, you have forbearance, short-term solution, repayment plan, semi-permanent solution, short refinance versus loan modification. Short refinance costs, because it's a refinance. Loan modification, you go straight to your bank. It's virtually free. Okay. If you have any questions, contact Lacey Robertson, the hardest working woman in mortgage and real estate, by calling 714-914-7254, or reach out to me on Facebook at facebook.com/simple loan modification, or follow me on Twitter, twitter.com/simple loan mod. I love you guys. I'm praying for you and your families that you will be able to be helped, educated by my videos, and ultimately do what's best for you and your family. Take care.